Jay Powell really wants to shrink that balance sheet, and he's the last one who's focused on that and just a thorn in Bill Dudley's side. And I said, but how do you pay attention to somebody who's quiet as a mouse? Just slowly follow this guy. He's methodical. He doesn't have to be there. When he left the Carlyle Group, he's probably worth $125 million net worth. I mean, this is not a job that he needed. Jay Powell never needed the pension, never needed the health benefits. He's there for a different reason. Jay Powell joined the Federal Reserve Board in June of 2012, and he was a really quiet figure for years and years. Just he was like, picture the opposite of Kashkari or Bullard, just absolute opposite in terms of a media hound. So when Richard retired, I retired summer 2015. We ran into each other at a football game in Austin, Texas, and ended up chatting in the lobby of the Driscoll Hotel there. And he said, I want you to keep your eye on one person, and only one person. There's only one person left standing in that room now that I'm gone, now that Charlie Plosser's gone. Jeremy Stein had left before them Tom Hoenig had left. So there were really no dissenters left. They were just a bunch of yes men and yes women, especially to the yes woman herself, Yellen at the time. But he said, I want you to pay attention to Jay Powell, because he's the only person who's still a thorn in the side of Bill Dudley wanting to stop reinvestment. Jay Powell really wants to shrink that balance sheet, and he's the last one who's focused on that and just a thorn in Bill Dudley's side. And I said, but how do you pay attention to somebody who's quiet as a mouse? And at which point, because Richard was a media hound himself, is still. And he said, just slowly follow this guy. He's methodical. He doesn't have to be there. When he left the Carlyle Group, he's probably worth $125 million net worth. I mean, this is not a job that he needed. Jay Powell never needed the pension, never needed the health benefits. He's there for a different reason. And we have to remember that about him. This is the person who worked with Warren Buffett to resolve Salomon Brothers coming out of the Treasury scandal. There are things about Jay Powell that nobody appreciates or knows or even wants to know. They just want, Elizabeth Warren and Rick Scott. They need a bad guy. They need a fall guy. They need somebody to blame on election day in 2024. And that's to come full round trip. That's who Jay Powell's become. He's the bad guy. And he's allowing himself to be the bad guy. So why? Why is the question? William McChesney Martin, he ran the New York Stock Exchange. And he was one of the few people to stand up to different administrations, different political parties, and was famously thrown up against a wall by Lyndon Baines Johnson in outside of Austin, Texas. And, boys are dying in Vietnam and you've got to lower interest rates. And he did. For 5 hot minutes, he made that mistake. But other than that, you also look to sort of Paul Volcker. He came up through the New York Fed, but he understood banks a lot. He was no PhD. I mean, he used to bring all the PhDs when he moved to Washington, D.C., Volcker, into a room and then trash the Phillips curve for fun. I mean, this was a great guy. But you have very few kind of, especially in modern history, who weren't really kind of PhD types. And McChesney Martin, Volcker, and Powell, they're kind of the standouts. And by the way, they're also the most effective chairs in history, except people would argue that Powell's the least effective. I think he has a respect and a veneration for the United States standing in the world, and where that's going to end up being, come what may, come what happens with China or not. So I think he's a patriot, or he would not be subjecting himself to this kind of torture. Which, I mean, you can see it in his face. He's just somebody who's like, okay, I'm ready for the next shot. Hit me. And that's
enemy number one.
He is. Whether it's Congress, whether it's Wall Street, whether it's his old private equity buddies. I mean, they were like, dude, after the pandemic, you expanded the Main Street lending program for our PE portfolio companies, and now you're driving us into the ground. I mean, there was a story on Bloomberg 2 days ago that PE's getting 39 cents on the dollar. I mean, they're just getting raped and pillaged. And it's because going back to August the 12th, 1987, Greenspan rode to the rescue within months. With the crash of 1987, he started filtering, hey, New York markets desk, go ahead and let the all your bond trading buddies on Wall Street know that we're about to inject liquidity into the system. So they don't have to worry about, the stock market going down anymore. I'm here to save the day. My name is Alan Greenspan. I was never popular in high school, but I'm popular now. But it's been since then that investors have had to deal with price discovery, and they're dealing with it now. I mean, leveraged loan recoveries. I did a triple take. I wrote a whole weekly about it, that the depths of the great financial crisis, we're talking like 2009, recoveries were like 36 cents on the dollar for leveraged loans. Today, they're 33 cents on the dollar. That's your starting block. God knows where you're going. And Jay Powell is as long as he methodically continues 1 week at a time, 1 month at a time to hold steady. It doesn't matter if rates are rising or not. If you have to refinance into this shit show, excuse my French, what a mess. Because you're doubling or tripling your financing costs regardless of who you are. He was pointedly asked, and hats off to her, Politico.com reporter, finally broached the subject of the balance sheet this last press conference after the pause. Does pause necessarily lead the discussion to when are you going to stop doing QT? And he was like, nope. He was not that dismissive, but he ain't talking about it. So he's very methodical when it comes to the balance sheet. And, every whatever the day that falls after typically it's the 30th or 31st of the month, whenever that treasury maturity date is, depending on the month. But every H4 that follows that, so that it'll be like July 6th this month, you see that $50 billion roll off, and it's steady. And my mentor, Lacey Hunt, will say, and it's manifested. It's manifested in M2 growth, or the lack thereof. It's most negative since 1937. It's manifested in other deposits, liabilities pre-Silicon Valley. It was already negative year over year. So it's working. Whatever it is that he's doing, it's working. It's just working really slowly, and he's good with that. He's way happy with retail investors, keeping the stock market going and zero date options. He's happy with all of this because it gives him cover to keep going. Let's do some Socrates here. In 2018, before junk bond issuance froze for 41 days, forcing the Powell pivot. That's the boogeyman. You cannot have the capital market. You can have the capital markets be crippled, which they are right now. You cannot have them freeze completely. You got to have somebody out there floating a deal. Carnival Cruise Lines, whoever it is that keeps selling junk. But he is extremely methodical about this. But go back to 2018. When he took rates back down to zero, what did he have to play with? 250 basis points. Now, let's say he's decided, because he reads me, that 2% is the new zero. Let's just say zero interest rate policy, ZIRP, is a tool that's being tossed out of the toolbox. Didn't work, screwed up things, encouraged speculation, blah, blah, blah. Let's get rid of it. Toss it. Great. I've got 300 basis points or more, depending on what happens in July, to work with to get me down to the new floor of 2. Now, that doesn't work for people who want a zero interest rate environment, because that's what's made the wealthy wealthier. It's because you can play all kinds of weird games at a zero interest rate in a zero interest rate environment. But let's say he knows that he's already got 300 basis points, 50 basis points more than he had to lower last time. When the unemployment rate finally pulls up, which he knows is going to happen. He's not stupid. He sees Indeed.com. Job postings are down 22% year over year. He sees Trueflation, 2.38% right now. He's not stupid. And he certainly knows that he's been burned by his board to a crisp with this inflation business and their models and everything that had left, transitory. All this has left him bitter towards his own staff, and rightly so. But he knows he can get rid of QE. He just can. And throw that out of the toolbox right there with it. And by the way, as a little bonus round, when he does eventually lower interest rates, he can just let those mortgage-backed securities roll off the balance sheet as they prepay, and just have that occur in the background as well, and get the Fed out of the credit easing business. It's against the Federal Reserve Act of 1913, by the way. No credit easing. You may never purchase the paper of a government-sponsored enterprise. It's in the verbiage of the original 1913 Act. But he knows he can get rid of 3 tools at once that are broken if he's calm, if he's the quiet guy in the background who just steadily keeps going. Try selling the mezzanine tranche of a commercial mortgage-backed securities. Just try it for fun. See what happens. Because you can't. So right now, banks are in the position that they actually have to hold on to the equity and the mezzanine tranche. All they can sell is the AAA. That's why issuance is down 85% year over year.